The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Mark Longo here from the Options Insider Radio Network and the optionsinsider.com, and I'm breaking in to your regularly scheduled program to give you guys an update on our Options Insider educational series. Now, a lot of you guys have been asking us when we're going to do something else like our groundbreaking unusual activity forum that we held back in May at the CBOE. Well, mark your calendars for December 7th because we're diving right back into the educational fray with an epic event on that Saturday, December 7th. We're going to break down the retail options trading landscape with 3 seminars held in partnership with our friends over there at optionpit.com. We'll break down the key mistakes that cost retail traders real money in the real trading marketplace, as well as how to properly implement and manage and adjust some really critical strategies like debit spreads, credit spreads, collars, risk reversals, butterflies, covered calls, the whole 9 yards. And best of all, this is going to be an online event, so you can join us from the comfort of your own home in your favorite bunny slippers. Don't miss this epic educational extravaganza with 3 seminars from 3 of the leading names in the business. Reserve your seat today at theoptionsinsider.com/events. And now I'll return you to your regularly scheduled program.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. We are, of course, your source for all the information you could ever possibly want to know about the world of options, particularly for those of you out there, the beginning retail options traders who are kind of dipping your feet into these waters and testing them out, seeing if you like them, seeing if you like the temperature. Well, then we have some information for you. My name is Mark Longo from the optionsinsider.com, as well as from the ever-expanding, ever-exciting, ever-insightful Options Insider Radio Network. And I am joined, as always, by my compatriots on the old Options Bootcamp Drill Instructor Squad. Starting off with the man known as He of the Black Hat, He of No Name, also known as Dan Passarelli of Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Oh, it is splendid. Splendid to be back on this balmy winter day here in Chicago.
I don't think our listeners know this, but you were known to actually wear one of those Mexican ponchos and a nice little cowboy hat on the floor on a regular basis, hence your man with no name moniker.
Yeah, the poncho, I actually still wear the poncho, but usually when I can't find my smoking jacket and I'm sitting around the house, I don't wear it out in public anymore.
It's only for special occasions.
Yes.
Speaking of special occasions, we are also joined by the Options Major Domo over there at SogoTrade.com. One Mr. John Critchley. John, welcome back to the program, sir.
Hi, Mark. Hi, Dan. Great to be back. We had a few snowflakes this morning in New York City, which is just wonderful. Very exciting for my children, not necessarily for myself, but I'm excited about today's show. It should be fun.
And what legendary character from the silver screen did you impersonate during your time on the floor there, John? Were you perhaps more of a Charles Bronson guy, John Wayne? What was your deal?
Clint Eastwood, make my day.
Oh, so you're both Clint Eastwood. Dueling Clint Eastwoods on the show today. We may have a problem. There may be an issue, listener. Stay tuned. But for now, while they're getting their guns polished and ready, we're going to roll right on into a very special mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, I love that transition. It always gets me in the mood. Seems like it gets me in the mood for 4th of July. I want fireworks whenever I hear that transition. I guess appropriate for Veterans Day. We're recording this not that long after Veterans Day here, so I suppose that's appropriate. Maybe it brings back some Flag Day memories, some Memorial Day memories, whatever your patriotic holiday of choice memories are. That transition will bring it to the fray. But I mentioned at the top of the show here, we're doing a very special mail call segment. This isn't like a very special episode of Blossom. We're not going to get into some of Dan's deep and dark personal history. Instead, we're going to get into some of your questions. You guys have been writing in quite a bit, writing in a ton of questions. We want to make sure we have time to get to them. So every now and then, we like to turn the mailbag open and just turn it over and just shake it and get everything out of there, and so we make sure we get to all your questions. We got a lot of great ones, and we got some time to devote to them today, so let's get started. We're going to kick things off here with a question from Mr. Benjammin. I believe this came in by way of our website at theoptionsinsider.com. Let me just say at the top of the episode here that if you want to join your fellow listeners, a lot of great ways for you to do that. Of course, you can post a comment on our website, theoptionsinsider.com, either on the show notes for a particular episode or wherever you want to post it, whatever article catches your fancy, and we'll find it and we'll route it to the appropriate show. Or you can always find us on Twitter, twitter.com/options. A lot of you guys like to do that. Or on Facebook, facebook.com/theoptionsinsider. A little less question traffic on Facebook. I think maybe because Facebook is still the teen and housewife demographic for a lot of it. And I guess there isn't a lot of overlap with that in the options audience, but we're getting there a little bit at a time. And, of course, you can get us the old-fashioned way via email, questions@theoptionsinsider.com. Just be sure to put question for Options Bootcamp in the subject line so we know which show you're referring to. All right, first off, we have a question here, like I said, from Mr. Benjamin. He writes, I am currently a law student. Well, congrats on that there, Benjamin. Hope it's going well. He continues, and I have always been interested in options. I've read about options, and I'm now listening to all of the Options Bootcamp podcast, which is a great show to prepare to start trading options. So, well, first off, let's just congratulate you there, Benjamin, on having great taste in podcasts. You truly are a discerning gentleman. All right, he goes on to write, scenario. Assume I sell a naked put option and I collect $500 in premium. 1 week prior to expiration, the value of the underlying has increased, and it looks like the option will expire worthless, and I will get to keep the $500. Is there anything I can do other than waiting to expiration to lock in my profits by sacrificing a portion of that collected premium? So this is kind of the quintessential question from a lot of premium sellers. We get variations on this on a regular basis. I'm sure a lot of you out there are thinking this yourself. Hey, I sold this option. It's gone my way pretty well. What can I do to lock this in that doesn't really cost me some of that premium I am so dearly invested in trying to harvest? Unfortunately, there aren't a lot of good answers for you, Mr. Benjamin. Mr. Passarelli, I'm guessing this is the question you get a lot from some of your newer mentoring students. So why don't you walk Mr. Benjamin through his options, or perhaps lack thereof, pun intended?
Why, yes, Benjamin, there actually is something you can do. And this is something that once you've been trading for a long time, it's so obvious and second nature, and you don't even think about it. I mean, it's not even a question. But to be fair, I work with a lot of traders. A lot of them are new traders. And you know what? It's not something that a lot of new traders think about, but you should. It is take your chips off the table. You know, you're in Vegas. You're having a great run at the blackjack table. Pick them up. Walk away. Maybe the streak will keep going, but maybe all of a sudden it'll turn around and you'll lose everything you made. That can happen with options. So My general rule of thumb, I mean, especially with spreads, but even with something like naked puts, once you've made 80% of the profit that you can potentially make, so in this case, you made $400, take it off the table. Close it out. Don't wait until expiration, because you know what, man? If I had a nickel for every time somebody had on a trade and they thought, oh, well, you know, this is just going to expire worthless, you know, it's going to be fine, I'm just going to sit and wait, and then some crazy thing happened that they didn't dream would possibly happen in a million years, but of course, you know, 3, 4, 5, 6 standard deviation things happen on a, you know, well, I guess on a regular basis is not the best way to put it, but more often than they should, per nerdy leptokurtosis conversations. So don't sit there and wait for expiration. You know, you always think about it in terms of risk reward. Like, okay, I can make $500. I've already basically made $490. I can make an extra $10. But if something crazy happens, I could lose that $500 plus thousands more. What should I do? Should I try and make $10, or should I just close the sucker and move on to the next trade? So that's my rule of thumb for my students. If you can make 80% of the max profit, close it down. Plain, simple.
You know, Mr. Passarelli, I've been at the Vegas tables with you. I've seen how you gamble, sir. So I don't know. I don't know if you should be dispensing this wisdom here too.
Well, valid point.
Mr. Critchley, I think you have something to add to this one.
You know, this is a very, very dear to my heart, and whenever I talk to a customer during expiration, which we take very seriously, I always advise to buy back your options. You know, especially under a dime, where, as Dan said, 80%. If you made that money, but always buy them back if you can. You just never know when something's going to happen. And, you know, Mark mentioned this privately to me one time about having a commission discount for closing transactions on expiration, and we're going to try to implement that. The programming is a little tricky right now, so it may take some time, but it was a great idea by Mark, and I think that would really give further impetus for our customers to close these positions. So I'm hoping in the next few months that if we get approval, that we can have some kind of discount for our customers that close their positions, let's say under a quarter, under 20 cents on expiration Friday. It'll make it better for everybody, less risk for us and the customer.
Well, that's great news, John. I'm really glad to hear that, because that's something I beat the drum with at every brokerage that I possibly can, because you're right. It makes a ton of sense for you guys. It makes a ton of sense for the customer, for a variety of reasons. People are already, as we've seen with this question, people are already just naturally disinclined to take off that position when they haven't harvested the full amount of premium. There's just something in our psyches, particularly in the premium seller psyche, that makes you resist doing that. It makes you resist taking it off. Why collect 80% when I could collect the full 100%? People don't realize that last 15 or 20% of that premium, that's the hardest nut to crack, and that's going to take a long time to erode, and usually your risk factors are going to change dramatically by the time you get to that portion of the premium. So maybe it takes a little bit of a mindset change in general. People don't think of, hey, I'm collecting all of this, I'm going to collect. Think of it, if you think of it as saying, I'm going to keep 80% of that going in, that's probably a much healthier mindset and easier to achieve long term, because you're not scrambling to get that last 20%. But John, I'm really happy to hear you guys are doing that, because that's just something I think every broker needs to do. They need to incentivize people, get them past whatever mental hurdles they have, because if they're already reluctant to do it, then on top of it, you're charging them a full freight. There's something else psychological by a lot of customers out there that refuse to close a position out and pay more in commissions than the trade is worth. That really rubs a lot of people the wrong way. So if you can take away that hurdle for them and incentivize them even more to do that, I think that's just a fantastic thing. So well done. Ballyhoo to you, John. Hopefully you get that implemented soon, because I really think that would be great for you and for all the Sogo Trade customers. And again, if you haven't checked out Sogo Trade yet and you're listening to this show, you've been listening to this show for a while now, what are you waiting for? These guys really put a lot of effort into producing this show for you. That in and of itself, John's appearances on these show on a regular basis shows their commitment to you guys, the beginning options trader. Check out their platform. I think especially for the pricing and the tools and the functionality, you guys are really going to like it. SogoTrade.com. Kick those tires. See if you like it. And then we can all be quite excited that you came from the Options Bootcamp podcast. All right, great question, Benjamin. Next up in the old epic, very special episode of Blossom, we have a question from Mr. Richard D. He's a big fan of the network. He writes in to a lot of our shows. He's a really big fan here of Bootcamp, so we thought we'd get one of his questions featured here on the show as well. He writes, Mark and the team, the shows are consistently great. Thank you. Well, another man of discerning taste. We have some very, very, very high-quality listeners here on this program. He goes on to write, you may remember me from the mega question earlier in the month. I'll be a little more terse in these posts. Also, thank you for that Bootcamp episode on vol and skew. So there you go, Dan and John, someone who was a fan of the vol and skew episode that we did just very recently here on the program. He goes on to write, I think expiration and settlement could be a good topic for a future Bootcamp show. Could you discuss a little on how American-style options stop trading on Fridays but actually expire on Saturdays, at least for the monthly version? Is anyone allowed, like for example brokers or large institutions, allowed to trade these options after they stop trading for the retail investor? I understand there are ways a trader can get hurt by this, because if you hold a short option at the Friday close, even if it's covered option like a bear call, and the stop gaps, I think it means the stock, and the stock gaps up after 4 p.m. on Friday, you'll get exercised, or you'll be assigned in this case, and then be short or long a lot of that stock come Monday morning. Could your team discuss what happens if I'm holding a long position and hold it past 4 p.m. on Friday? If it's even a penny in the money, it gets exercised. However, does the timing on that work? Here is a hypothetical example. And he goes on to list this example. I own a Nove 100 call here on XYZ stock. Stock closes on Friday, November 18th, which is, of course, coming up next week for expiration, at $99.99. But then by 8 p.m., it goes up in the after hours to $100.15. Is my contract automatically exercised? Alternatively, stock XYZ closes on Friday, November 18th at $101, but then by 8 p.m. that evening drops to $99.99. Again, what happens? A lot of great questions here about the exercise and settlement process. I know it is very confusing for a lot of you, so I'm glad he wrote in about this. John, maybe we'll take it a little bit in order. We'll try that.
Yeah, well, let me start from the beginning, because this is actually one of the things that we get questions from especially from the new traders all the time. It's about the expiration date on because when you look at an option contract, it gives you the day of expiration in the option symbol. But options, as we all know, at 4 p.m. on Friday expiration or expiration day, they stop trading, but expiration is Saturday morning. But that's how it used to be. And now that's semantics only, because as of June of this past year, expiration processing for the monthlies and the weeklies, so the monthlies, is now Friday evening, not Saturday morning. I think last summer, in July 2012, the OCC made that determination that June 2013 would be the first month. So now all the every expiration, including monthlies, are done. They expire 4 p.m., and then the processing is Friday evening. So what happened for us as Soko Trade is that it just moved the timetable forward for our back office processing. So now, if our customers want to do any kind of contrary instructions or anything of that sort, they have to do it now a half an hour earlier. I think they have to do it now by, I think it's 5 p.m. Eastern time, and it used to be 6 p.m. Eastern time. So that changed things. So now everything is done, Friday evening. And also that makes it easier for the customer to understand. Options expire Friday, 4 o'clock, and they're all wrapped up by Friday evening.
Yeah, this was always a really opaque area of the business. It caused a lot of issues. This clearing and settlement process also led to exploits like dividend trades and other things like that. It's nice to see that the industry is finally catching up to this, and they've been tweaking it for a while. They tweaked the automatic exercise thresholds a couple of years back. It used to be, I think, a nickel. They've cut that down to a penny now, so if you're in the money by a penny, then you're automatically exercised. So a lot goes into that. But you're right, Mr. Richard here, that it still is an opaque process, and particularly in some of the hypothetical scenarios you outline here at the end of your question. So, John, maybe let's walk him through these hypothetical scenarios as well. Let's say for the first one, there's $100. He has a $100 call. Stock closes at $99.99 right at the close. In the after hours, it goes up to $100.15. So, walk Mr. Richard D. through what happens in that scenario.
Well, there's a 4 o'clock official close, and if you look at SogoTrade or any other online platform, you'll see the official close. So if the official close is under the strike, $99.99, then that will not be automatically exercised. And if the customer wants to exercise it, if he's long it, he needs to send in or he needs to call us and do exercise by exception. So that's the one, I think the one question there. What was the other question? If it goes the other way around, if
it goes the other way, if it closes at 101, which is $1 in the money, and then the after hours drops to $99.99, what happens there?
Again, a customer can, submit a do not exercise instruction to us. Usually we say by 4:30, but really up to 5 o'clock. But we have to submit to our clearing firm. So 4:30 is really the cutoff. But they can give us a do not exercise instruction, and we will not exercise those calls on their behalf. The one thing I want to bring up is that when you're long an option, you or even to some extent SogoTrade, the broker controls what happens. But when you're short an option, this goes back to the first question, you don't control that. We had a customer in SPYs last week. I think they closed 176, maybe 15 or 16, and he was short some 176 puts. He didn't buy him back. We didn't make him buy him back. He had the margin to cover in case anything happened. But guess what? They got a put to him or assigned to him, and he didn't know about it until Monday morning or Sunday night. We informed him. So, and he was lucky because the underlying opened up, I think, at $0.50. But this is a perfect example where there was risk over the weekend for this customer. And he could have bought him back or a nickel or dime or probably 2 or 3 cents, but he didn't. So just be very careful when you're short. You do not control the assignment process.
Yeah, there's a couple of important takeaways from this question. First off, as he asks here at the end, the closing price is what matters to you from an automatic exercise threshold perspective. But the after hours is immaterial almost to the broker from that perspective. The automatic exercise is calculated at wherever it closes. So in that earlier scenario where you close a penny out of the money, guess what? You're not getting automatically exercised. The stock could go to the moon in the after hours. That's not factored in. But you, as a trader, need to factor that in to your calculations. You need to watch that after hours so you know what's going to happen to your positions. Because, like we said, the stock closes at a certain time, but there still is several hours there where something could happen. There could be an earnings announcement. There could be some big macroeconomic development that could move your position in the after hours. And all of a sudden, like John outlined, you could find yourself, let's say if you have a short position getting assigned, and now all of a sudden, let's say your short call is naked, now you're just short a bunch of stock. And you weren't expecting that coming in Monday morning. All of a sudden, wow, I'm short a ton of Apple, and Apple now just shot off to the moon. So because you weren't paying attention in the after hours, someone else was. They saw that, let's say you're short the 500 strike, and Apple maybe rallies to 505 in the after hours. Guess what? They're going to exercise those, even though they were perhaps it closed at 499, and so they weren't automatically exercised. But they were watching the after hours. You weren't, and so they exercised those options. And now something you thought was going to go out worthless and make you a lot of money is now a huge loser for you. And that's, again, even perhaps more important than all of this, goes back to what we said many times on this show, is particularly on the short side of the fence. If you're short something and you're going into expiration and you're hovering around the strike and you're not sure what's going to go on, close the thing out. It's stupid how many times people lose tons of money, substantial amounts of money, huge percentages of their net worth or of their portfolios because they refuse to do simple little things like this. If you got a nickel either way and you're worried about commissions or whatever, we talked at the top of the show about reducing those commissions to further incentivize you. But this question is another great example of why, if you have positions going into expiration, you should close them out in general, particularly if they're hovering around the strike or close to the strike and you're kind of worried about them. Maybe you're short some out of the money calls and you think they're going to expire worthless. You don't really feel like buying them back for a penny. But you know what? In the after hours, all of a sudden, some other competitor or some other firm releases earnings or pre-announces something, the stock takes off. Next thing you know, your stock is moving with it, and someone who's paying attention to the after hours exercises those, and now you're getting assigned, and you're short something you weren't expecting coming in Monday morning. That's a worst case scenario. That's something where you have risk you didn't know about and weren't anticipating and weren't planning for, and that could mean, in the case John outlined, the guy got randomly lucky and made some money, but 9 times out of 10, it's not going to work out that way for you. Mr. Pastorelli, anything to add to this, or you want to keep on rolling to the next question?
I mean, maybe just really quick, and I'm basically just agreeing with what you said, Mark. A lot of times people hear the term pin risk and they say, oh, Dan, what's pin risk mean? And I'll say, well, it's the risk of not knowing whether you're going to get assigned. And, people look at me like, well, that's kind of obscure. Like, it's hard for people to kind of wrap their head around why that's such a huge risk. But man, let me tell you, once you get surprisingly assigned and you wake up Monday morning, being long 1,000 shares of a stock that's down $10, then you really appreciate what pin risk means.
Yeah, that's something we as traders used to wrestle with quite a bit on the floor. You get pinned all the time, and we're seeing it now happening with much more frequency, particularly in some of the highly liquid names. Stock just gravitate towards those strikes. So if you're trading a lot of equity options, you're probably going to encounter this. Also, people forget SPY. SPY has that quarterly dividend people just seem to forget about. And so we get those kind of surprise announcements after hours, people not realizing that SPY has a dividend of maybe $1 or whatever the case may be. And then they forget to factor that into what strikes they should close out. And then, of course, they end up coming in. Similar scenario, people are exercising calls they weren't planning on having exercised and assigned against them. And now all of a sudden, guess what? You're short coming in on the SPY coming in on Monday morning, a position you don't want to be in. So, again.
Mark, can I just mention one thing? We're talking a lot about short positions, but, long positions or in the money, I'm talking about in the money positions. Be careful there, too, because Solo Trade, since I run the expiration day process and I'm an ex-trader, I'm very sympathetic to retail customers and traders, but we do get customers that have in the money positions that sometimes ignore them. And then what happens is that we have to go into the marketplace and close the positions for the customers, maybe do not exercise for them, or in some extreme cases, we need to do stock in the after hours to protect us or to give the customer some money. So be very careful, closing down out of money positions. Say that you're short, but if you're long a position, it's in the money. Close it down too, and don't wait for the firm or the broker to do it for you. I know that we wait very, very long, but sometimes we can't wait, and so please close your positions, long or short, before it gets too late, or else we may take action on your behalf, and you don't want that.
Yeah, you don't want that. On your behalf is a euphemism for shutting down your risk before you get to it. You don't want to be in that position. I'm looking here and at our list of episodes. We've done a lot of episodes with various ways to use options in lieu of or in place of or in conjunction with stock. I don't think we've ever really discussed pin risk in that much detail here on the show. Obviously, we just touched on it just now, but maybe that might be something we could investigate as a discussion topic for future episodes. Really dive into that, because judging by this question and some of the other ones we've received, this is a topic that's causing some consternation for a lot of our listeners, and that means it's something we should be talking about. All right, speaking of subjects that cause consternation, a lot of you guys wrote in with questions about our recent episode on volatility skew. I'll hit on a couple here. First off, we have a question from Little Rich, and he writes, can you explain the origins of volatility skew? Is it true that skew didn't exist pre-1987? And that essentially is true, Mr. Little Rich. We skew really, as we said on the most recent episode. And again, if you missed that episode and you want to go back and have a little bit of a primer here on how all this stuff works, then go back. Actually, it wasn't our most recent episode. I misspoke. It was episode 32 we posted back on October 24th, all about volatility and skew. So dive into that. You can learn about all this stuff in much greater detail. But yes, Mr. Rich, it is essentially an observed phenomenon in the marketplace, and people had all their volatility skew models and their charts and graphs. They had their predictions for how options would perform going into different events. And that certainly existed pre-1987. It might have been a little bit more rudimentary than what we have today, but it existed. People had charts, and they thought, here's what's going to happen if the underlying moves here. Here's what happens to volatility. Well, the problem is they were just wrong. They didn't really factor in what actually takes place in the marketplace. And what happened in 1987, obviously a cataclysmic event, a huge shock to the system. People observed the way the underlying and the options actually performed in that scenario, and that's where skew was kind of given birth to in the marketplace. People said, wait a minute, these puts aren't performing at all how we thought they would, and these calls aren't performing at all how we thought they would. Perhaps there's something else at work here, and that's where a lot of the academic and practical research started turning towards what is this phenomenon. That's what kind of became loosely known as volatility skew as we discuss it today, that type of shape that most of us are familiar with, that investment skew of having the calls essentially being depressed from the calls being depressed from an implied volatility skew perspective, and the puts being inflated from an implied volatility perspective. So great question, Mr. Little Rich. Again, check out that episode if you want to learn more, or of course, check out our entire program of volatility views, a great program. We got into a lot of that stuff on that show. Next up, we have a question from Eric Thamos, and he writes, I love the Bootcamp show. Again, another discerning listener guy, so there you go. He goes on to say, it's a great resource for newcomers to options like me. I'm listening to the skew episode on the train home right now. I'm still puzzled about the actual fundamental underpinnings of skew. What is the bigger determining factor, the actual order flow or the psychological factors? Also, is it possible to impact the skew myself? For example, if I see a stock where the skew is inflated, could I sell it and deflate it, locking in a profit in the process? Thanks again for this insightful program. A lot to discuss here. Mr. Passarelli, I think this one probably right up your alley. Why don't you get us started here with the answer from Mr. Thamos?
Yes, sir. Order flow determines everything. I mean, it's supply and demand, baby. Somebody comes in and snaps up a bunch of calls, and calls might not be cheaper than puts. I mean, that's the whole thing that we've talked about on the show a couple of times, the inverted apple skew that has sometimes been observed, where the calls are actually more expensive than the puts. Or I actually haven't looked at it in a while, but I know it was like that for a long, long time. And why is it like that? Or why was it like that? Because most people who were trading Apple stock were retail people, and they didn't know. They just, they weren't necessarily always the smart money, and they were just buying calls because they figured Apple does nothing but go up, and they were creating those opportunities like you're alluding to, where somebody like yourself who can observe these things and say, what the heck's going on here? This looks totally out of whack. You can jump in and you can take advantage of that skew. And if you're really, really well capitalized and you can throw around a lot of money, yeah, you can move the skew as well. I mean, typically a typical retail trader doesn't move the skew, but somebody from Goldman Sachs or somebody like that certainly does all the time.
Goldman Sachs. I like that, sir. A little dig at our friends over there at Goldman. Mr. Critchley, anything to add here for our friend, Mr. Thamos?
Yeah, I mean, I'm going to hit on what Dan said. I mean, and actually in my notes I put down order flow, supply and demand. That's exactly what Dan said. It's driven by the perception of risk. And I think one of the parts of the question was, can the customer influence the volatility by himself? And the answer is 99.9% of the time they can't, because a customer can never be bigger than the marketplace. The only time you can really influence it, I think, would be in an option that has very low liquidity. And if you go in there and try to do something by buying a lot of options or selling a lot of options, you may be able to influence it. But guess what? Now you're either short the options or you're long them, and there's no liquidity. It's going to be very hard for you to get in or out. So the retail customer it's almost impossible for them to drive skew or to drive the implied volatility of an option. It's actually very hard for traders. When I was trading, it was pretty hard for the traders really to do that. It was more institution or hedge funds or very large traders. So that's the answer to that question.
Yeah, Eric, I wish you were sizable enough to move the skew. In which case, I wish you more power to you, sir. But there are very few customers out there sizable enough to see an inflated or deflated skew and move it in the other direction. But you can, of course, profit from it. Doesn't mean you have to move it. You can, of course, take advantage of all the different ways we talked about on the show. If you see, let's say, an inverted call skew, you can leg into verticals for prices that are extremely favorable and things like that. And then you can take advantage of that, regardless of what your actual impact on the skew may be. As to the first part of your question, Dan and John are of course correct. the order flow is king. Order flow drives everything, and the order flow is a result of these psychological factors that we talked about before on the show. You know, people are essentially along the market, so they're looking to generate income and also buy protection, and also they have concern to the downside and euphoria, elation to the upside. So all of these things combine to result in the order flow that we talked about before, which in a large number of very large listed equities and a lot of indices as well, you see this predominance of call selling above the at-the-money strike and put buying below the at-the-money strike. It's not universal by any means. There are names that do their own thing. Apple, Dan mentioned, a number of others. Facebook has exhibited some of that recently, but a lot of other names have flirted with that on occasion. Some biotech names coming into big announcements, FDA announcements and things could have all kinds of crazy skews. But in reality, most of the names you're going to be trading will probably exhibit that lower implied volatility to the upside, higher to the downside. And that's just a result of these psychological factors we talked about here on the show before. So great question, Mr. Thamos, and good luck in your trading. Hopefully you are Goldman Sachs. Hopefully you are big enough to move that skew. And good luck to you, sir. All right. Next up, this one has you written all over it, Dan. Not just because you're mentioned in the question, but it's right up your alley. This is a question from Tim Santiago from Albany, New York. Scenic, lovely Albany, New York. He writes, I'm catching up on options basics, including the Greeks. And he says, in parentheses, great book, Dan. Most of them make sense, but I'm kind of hung up on two, rho and delta. Why do we need rho? Is it me, or is it really a superfluous variable? Have you ever encountered a circumstance where your knowledge of rho came in handy and saved the day? Maybe we'll cut it right there for now, and then we'll get into the second one, part of his question in a second. But we'll start there, Dan. I personally can't think of a scenario where I said, wow, rho, thank God. Thank God I really knew a lot about rho. That saved the day. You know, I think for most of our listeners, the only scenarios I can really imagine, obviously interest rate, rho being your sensitivity interest rates, the only scenario I can really imagine a lot of people being impacted by that in terms of the audience for this program are things where they're doing longer-term options as like a stock replacement. So maybe you're doing a stock replacement strategy with a long-term leap call or maybe a long-term covered call type strategy, and that's where you might want to know the impact of rates on those types of positions. But other than that, I don't see rho being a big factor. But that said, I don't want to put words in your mouth, Mr. Passarello. You did write the book. I know you devoted about 7/10 of your book, 70% to rho itself. So walk us through rho and all of its myriad shapes and sizes, sir.
Well, rho is typically not extremely relevant these days. And it's typically not extremely relevant to retail traders because retail traders generally, trade 5 lots, trade 10 lots, and if the interest rate changes 2 points, it's not really going to make a big deal on their lives. Having traded as a market maker for a very long time during a time period when we had Alan Greenspan and the economy was really hot and he would keep trying to cool it down by raising the interest rate, and there was one time where, I think it was during a period of maybe a few weeks where the interest rate was risen by about 75 basis points, including 50 basis points in one single day. And, rho is kind of one of those risks that you try and manage as a market maker, and you try and just not have rho risk because it's sort of a wild card risk and you don't really know if you're going to make money or lose money. So I can't really remember if I made money or lost money when that happened. But it was probably something to the tune of $15,000, $20,000, $25,000, $30,000, during that short period of time because the interest rates were risen 75 basis points in a very short period of time. So, I don't know, didn't necessarily impact my trading career in the long run by that much, but, if I had have lost $25,000, I'd personally rather still have it. If I made it, I probably blew it on something I didn't need anyway. But it can add up when you're trading, especially a non-directional volatility, system, I guess, if you will, like a market maker. It can add up to something at least, somewhat significant enough to register on my radar and remember it for a story like this today, 10 years later.
There you go. an actual row in the wild story. I like it, Mr. P. John, anything to add on row before we dive into the second part of this question here?
I mean, the basic answer is that, the row, the interest cost is really built into the model, and it's built into the pricing. And Dan's right. Unless you get like a surprise, easing of the Fed or raising rates kind of out of the blue, everything's really priced in. It really affects the longer dated options. It's going to affect only a very big option retail customer. More institutions, they hedge themselves. So it's really something that I would not be concerned with if you're the retail trader.
All right, and the next part of this question is an interesting one. It's actually kind of timely for me. We've been discussing this a variation of this question with some people on the network recently, so it kind of comes as a good timing for us. He goes on, Mr. Tim Santiago goes on to write, as for delta, it seems like the super variable. It's a hedge ratio, a measure of price change, and the probability of expiring in the money all wrapped up into one shiny package. Is it me, or is that just too tidy? Do you find this to be the case in real life, or is this another example of mathematicians trying to extrapolate their findings to areas that don't really apply? This is an interesting one, actually, and something that I encountered when I first started learning all the Greeks back on the trading floor, and they handed me my book of Natenberg, and I kind of had the same initial reaction that you did, Tim. I was like, wow, delta is this super variable. It can do everything. And I started to learn over the course of time in trading that the first two parts of that were certainly spot on. It is indeed a hedge ratio for how much you want to hedge if you want to trade delta neutral. It also is indeed a measure of how much that price is going to move. Both of those are reliable and useful. It was that third one, that probability of expiring in the money, that I kind of had a hard time really wrapping my head around. And turns out there's a bit of some interesting debate going on behind that. But before we get into that, Mr. Passarelli, again, you devoted another 2/3 of your book to delta. So now we have 70% is row, about 66% is delta. Is my math adding up there? Does that sound about right?
Yeah, pretty much. And the rest are stories from the trading floor.
And then your childhood.
6/3.
There we go. I like it. So what do you say about all these myriad definitions of delta? How do you break down on this debate?
Well, I mean, what you're pointing out there, and again, short attention span, lost track how many you actually counted here. I mean, there's four, generally considered to be four. The textbook definition, rate of change of an option based on the change in the underlying stock price, the hedge ratio, the derivative of the stock price versus the option price, and then there's the one we were just talking about, which is kind of the interesting one, the likelihood of expiring in the money. Those first three they're actually all the same definition. Like, if you start to really think about it and, just like sit down and ponder and use all your brain power for like an hour, you'll realize those first three just say the same thing differently. The one, as far as expiring, the likelihood of the option expiring in the money, actually, I was kind of involved. Mark kind of bounced that idea off me. I don't recall how elaborately I responded. But here's the deal with that. That's what I call the trader's definition, and it's not really technically, mathematically accurate, but every single trader I've ever met in my entire life, professional trader, uses that definition. Delta is the likelihood of an option expiring in the money. Like last week, I was at the Options Alliance event, and it was the next day when I was at the FIA. And Amy, who works with us, she's like, Dan, are you coming into the office today? I was like, I don't know. I've got a couple of meetings. I'm like, 80 delta, I'm not coming in. It's just kind of how traders think. Delta is the likelihood of an option expiring in money. But it's not mathematically accurate because it doesn't reflect certain things. It doesn't reflect the trader's opinion on direction. It's just sort of somewhat of a bastardization.
Yeah, it kind of is, and it seems to be an interesting shorthand that has developed amongst traders, but it seems to have perpetuated this misconception amongst traders that this other definition of delta exists. And like I said, it was timely. I was just discussing this with one of our co-hosts of our other show, Volatility Views, who likes to delve deep into the mathematical underpinnings of all things options. And we were discussing this in response to an article he saw somewhere else where someone laid out the typical Greeks and all the definitions of the Greeks. And once again, they threw in that probability of expiring in the money, and that set off his alarm bells, and he got very fired up about responding to this individual. And he and I had an interesting chat about that, because I said, I've always been uncomfortable with that as well. And he was kind of saying, it's interesting how it breaks down. A lot of traders really use that and kind of subscribe to that mentality, whereas a lot of mathematicians and the quants tend to know it's not true, and they don't subscribe to it. So it's a kind of little bit of a mix there. There's a lot of complex math behind it. Mr. Tim Santiago here, so I won't we can spend the rest of the show talking about the different integrals and derivatives that go into that. But essentially, when you actually boil down the math behind this, really delta is not equal to, and probably sometimes may not even be close to the actual probability of expiring in the money. In fact, if you look at some of the math behind it, delta probably should always be greater than the probability of expiring in the money. So keep that in mind when you're looking at this. One of the reasons why I haven't been super vociferous about breaking down this misconception, because I think, even though it is indeed a misconception, I think it does a kernel of good in the marketplace overall. Because I've always thought that if you tell that to a retail trader, if you tell them, hey, this is actually the probability of that option expiring in the money, maybe, just maybe, it'll stop them from going out and just say loading up on 8 delta calls because they're so cheap. So I kind of thought, even though we were kind of putting out there a bit of a half truth, or actually in the case of this case, probably a zero truth, a misperception, it really did perhaps serve some greater purpose. That said, this misperception has been out there for a long time, and people are still loading up on out-of-the-money garbage all the time and wasting a ton of money on it. So I guess that misperception hasn't really impacted that in the way that I hope. So long story short there, Mr. Tim, delta is this kind of magical variable, can do a lot of things. Most of those ones we talked about are all correct and useful, and like Dad said, they're all kind of variations on the same theme. Probability is a bit of an extrapolation that kind of rose out of the trading pits and for whatever reason has taken on this life of its own, and it isn't really that accurate. Or I should say really isn't accurate at all. So if you're looking at it from a hardcore perception, then discount the latter unless you find it useful and instructive to keep you from buying garbage options, in which case I say then embrace it wholeheartedly, sir, because the white lie that saves you money in the long run may be a beneficial thing. Mr. Critchley.
That was a wonderful explanation by Mark and Dan. The one thing I wanted to add is that, the reason why I like to use it is because exactly what Mark said, it makes it simpler for the retail customer. And if the real math behind it might be slightly off or is off, then you know what? Let's go back to the thing. If I tell a customer that delta is for every $1 move in the stock, your option is going to move, if it's a 10 delta, 10 cents. And then what happens? The stock moves $1 and the option moves 2 cents. And then they come to me and say, why is that? And I have to go through a big explanation of the implied volatility collapse, and delta is dependent upon implied volatility and other factors. So that's one reason why I like to use it, because the other definitions, maybe they're more mathematically correct. For the retail customer, this is one definition that they can understand. And actually, Mark is also 100% right on the fact that it also can dissuade a customer from buying an option for 3 or 4 cents. Wow, look how cheap these options are. But guess what? The delta is 3. So if you tell a customer you can buy them at 3 or 4 cents, but there's a 3% chance they're going to be in the money, maybe they won't buy all these lottery tickets.
Yeah, I've always found that if you throw that out there to the retail and then you equate it to a coin flip, which is, of course, 50-50 or close to it, and then they start realizing, wait a minute, my trade has a delta of 3. You're right. It might have a little bit of a dissuading factor to them, which is not, at the end of the day, a bad thing. And listeners, if you want to really dive deep into the mathematics behind this, there's a great article over there at a website called Risk Latte, L-A-T-T-E. The article is called Understanding the Delta of an Option. It came out back in 2006, but it still is very, very relevant and actually discusses this exact topic we're talking about today, how this misperception got started in the marketplace and some of the mathematics underlying it and why it really isn't the case. Check it out if you want to learn more, Understanding the Delta of an Option. All right, and we have time for one more. This actually comes from the Sogo Trade mailbag. John obviously interacting with a lot of clients out there, and he had a question. We won't repeat the name or maybe give any identifiable information to protect his clients, but the theme of the question goes back to what we talked about on an earlier show, an earlier mailbag episode, about fragmentation in the marketplace and how difficult it is to get quality fills and executions in the midst of all of that fragmentation. And John, I think you have a little bit more to add on that topic today.
Sure. We get questions almost on a daily basis. A customer enters an order. They enter an option order before the market opens, and they put a market price on the option. And then, sure enough, 9:30 comes, and they get a fill, for example, at 25 cents. And then they go to look at the option chain right after that, and the NBBO is no bid at 5 cents, no bid at 10 cents. And right away they call and they complain to us. And I have to explain to them over and over again, to almost every day to our customers, that when you send a market order out in an option, pre-market, what happens is that it goes to one of 12 exchanges. Again, going back to fragmentation of the marketplace. And that market maker that receives that order is not curtailed or restricted by the NBBO. They can print that market order actually at any price within reason. And that happens. So, again, I advise everyone to try to use limit orders in options pre-market. And if you really need to buy it, wait till 9:30 in 5 seconds or 9:30 in 30 seconds, and then maybe put the market. Because then if you do that, you'll get the NBBO. But if you enter the order pre-market, you will not get the NBBO. So be careful, please.
We can always put that as a disclaimer for every episode that we do, is don't put those market orders in on the open. Don't use market orders pretty much in general unless you really, really need to get out of something instantly. And even then, I think you really need to pick your battles a little bit more decisively. But certainly don't throw them into the fray around the open, because as John just said, the fills you're going to get are not exactly going to fill you with joy and enthusiasm. And you're probably going to end up calling a guy like John and saying, what the heck is going on? You're going to get an earful of exactly what we talked about today, fragmentation and all these other issues around the open that could really cloud the execution process. So do yourself a favor and don't do that. I think you'll be the happier for it. All right. That is all the time we have for this super mailbag extravaganza here on Options Bootcamp. Thanks to everybody who wrote in. I think we got to most of you. If we didn't have a chance to get to you, I'm sorry, but we'll get to you on another episode. You guys are writing in such great questions. Keep them up. Again, you can find us on theoptionsinsider.com. You can post your comments, your questions there. Twitter.com/options, Facebook.com/theoptionsinsider, or just questions at theoptionsinsider.com. Keep them coming. Great questions from all over the world. I really love to see the reach this show has and get the input and feedback from you guys out there. So keep those questions coming. We love to hear from you. And speaking of hearing from you guys, now it's time to hear from my cohorts here to see what they have cooking in their respective necks of the woods that may be interesting to you guys, the listeners. And I think a little birdie told me that, Dan, you guys over there at Market Taker have something big cooking and is you're unleashing to the world today.
We have something huge cooking that, for those of you who don't know, we record these episodes a little bit in advance. Today, as we're recording this, is November 12th, 2013, and today was the launch of the Market Taker Mentoring Elite Trader Community. And I warned you guys, I threatened you guys that it was going to be incredibly awesome, and you know what? It's incredibly awesome. And I am somewhat biased because I created it, or had it created, but I did it with the help of my students. Basically I said, what are you looking for? And I built it for them. And, a lot of chat rooms out there are built on crappy 90s technology, and it's just really, frankly, embarrassing. It's just text and it's yucky, and, you can't search for things. This is basically Facebook for traders, and it works really, really great, and it's awesome. And already today we've gotten great traction, and we haven't even really officially launched. The official launch comes in, 1 hour from this moment in time as we're recording this. And with the response we got in the pre-launch, it's going to be really, really popular.
I just want to know, can I post my animated Dan Passarelli GIF for my avatar? Can I do that?
Maybe. We do have, well, we have rules for the room, of course, and one of the rules is no excessive profanity.
Okay, so all those pictures I took in Vegas, those are all off limits.
Yeah, we definitely don't want to show those.
All right, let's segue away from that really quickly. Mr. Critchley, I know you guys have a lot of cool stuff cooking. You mentioned the commissions. That alone is worth the price of admission right there. I can't wait to see that one popping up on the old Sogo radar. What else is cooking in the land of SogoTrade.com?
Well, we're hoping to have by year end our new Sogo Elite, which is advanced charting, launched, and we're going to have also an advanced screener by year end. Our margin optimizer is working so far so good. We haven't actually officially announced it. It's been a soft launch, but no issues yet, so that's encouraging. And I'm hoping to, again, get this commission reduction. It's going to be, the programming actually is pretty tricky because the system has to go in and figure out if the position is closing, if the position is tied to another underlying position or another spread or cons or butterfly. So it's a little tricky, but we're going to try to work things out, and hopefully we can get it implemented soon.
All these elites, Market Taker Elite, Sogo Trade Elite, I feel like I'm left out of the party here. I need to do something Options Insider Elite now. I have no idea what that could be, but just to keep up with the Joneses, just so I can have an elite thing to throw out there too, I'm going to have to put that out there so we can have something fun. But John, thanks for that. And of course, we have that offer we mentioned at the top of the show. If you haven't checked it out yet, 100 free trades. Just surf on over to SogoTrade.com. Kick the tires. I think you're going to like it. You want to save some money on commissions, get some decent executions, and you get to chat with a guy like John. What more could you ask for? SogoTrade.com to check it out and learn more and get those 100 free trades. Can't do better than that. And on behalf of Dan and John and, of course, myself, I want to thank all of you guys out there in the listening audience. You guys have really been above and beyond, supporting the show, writing in with great questions, downloading it in ever-increasing numbers, telling your friends. We love it. Keep it up, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.